Let's talk about it with our featured guest of the morning. He's Jamie Murray, portfolio manager and head of research at Murray Wealth Group, and he joins us right now. Jamie, thanks a lot for joining us. What has happened to that rotation that many investing professionals were calling for through much of 2024, and that's a turning away from the mega cap tech stocks in favor of other sectors of the equity market, particularly mid and small cap stocks? What's happened?
I think we've seen that the AI trade has legs that, even a year or two ago were not available to most investors. And so we're seeing increased spending. We're seeing now the AI trade move into more corporate dollars. And we're just seeing these companies grow their earnings and revenue in a very actually sluggish economy, we think. It's really this whole AI-centric basket of companies that's really performing. But we're seeing a lot of signs in the real economy that things are not that great. So I think that's been the biggest reason why we haven't seen this rotation out of these names, is they're still the ones that are putting up numbers. We're seeing numbers move higher for these companies, and we're not really seeing that for the rest of the economy just yet.
Do the mega cap tech stocks warrant the valuation multiples that they're being given in the market right now?
Yeah, that's a great question. And I mean, there's a lot of bifurcation in terms of what each company is being valued. I mean, some names that we own in our fund, Meta and Alphabet, are trading just at multiples slightly higher than the S&P 500 overall. So we talk PE ratios in the low to mid 20s, where then NVIDIA, Amazon, and then companies like Tesla, you start to see higher and higher PE ratios. And so the higher you go, the more justification and more future growth you need to discount to get a return out of those companies. So, we think across the board, these companies have delivered very solid growth over the last decade, and we don't really see that slowing down. So we think that there's not overvalued by any means, but certainly you want to pick and choose which names you're in, we think.
We get a lot of questions, as I think you know, on this channel, particularly during our market call program, and you've been with us during market call on numerous occasions, about NVIDIA in particular. That stock's now trading at 49 times expected earnings. I assume you get questions on it as well from your clients. What do you tell them when they ask, should I be waiting for a pullback, or should I simply buy now, NVIDIA?
Yeah, so I mean, NVIDIA, this is a name that we actually have missed as well. We have not owned shares in NVIDIA in the last 5 years. So we missed that trade. But another name that we own is Broadcom, which is sort of another company that is benefiting from the AI chip build out. But we think there is still, we believe, like a good 3-4 year runway up for these companies. The real question is, are the AI models going to improve? Are this data center build that we're talking about, is it a 5-year build and then you're going to see that spending fall off a cliff, similar to what happened in the technology bubble in 2000? You had a ton of spending and then it just almost slammed shut one day, stopped completely. So is that what we're going to see as well for these AI data centers, or is this going to be a durable theme? And we're going to see bigger and bigger data centers, more and more computing power going in. And if that's the case, then NVIDIA and Broadcom probably still have legs.
What's your take on Microsoft? Microsoft trading at a 32 times expected earnings multiple.
Yeah, Microsoft is actually, it's another one of our holdings in our fund. And it's always traded around a 30 times multiple. So it's not out of line with where it's been historically. It's actually the fastest growing cloud business, growing a little bit faster than Amazon's cloud business. We think within 5 years, it may surpass Amazon's AWS business in terms of total size. And Microsoft is just a great company. It's a distribution play on technology. Millions of businesses run on Microsoft, and Microsoft, they're not necessarily the first to everything. Like, we think back to Zoom and Microsoft Teams. Zoom was clearly a superior product and was a leader in video technology, but Microsoft was able to use that distribution footprint and build a good enough video service player in Teams, and now we've seen that be a huge growth. So yeah, we think 32 times, especially for a software company like Microsoft, that's a fine multiple. We don't see too much expansion on that, but we think Microsoft can grow its earnings, call it 15% for the next 5 years, and that's what the type of return you would expect to get from that name.